Welcome. In today's video, I am analyzing Bajaj Finance. Bajaj Finance was set up in 1987 as a subsidiary of Bajaj Finserv, which owns around 52.8% in it. The financial service arm of Bajaj Group is a large diversified NBFC, non-banking financial corporation. The company has emerged as one of the largest retail asset financing NBFCs in India. The company has a diversified product suite which includes vehicle loans, 2 and 3 wheeler loans, consumer durable loans, personal loans, mortgage loans, small business and loan against securities, commercial financing and rural finance. The company is one of the largest financiers of two-wheelers and consumer durables in India. At the end of March 2020, the assets under management grew by around 18% to 1,16,102 crores on a standalone basis. The company is in segments such as mortgages, small business loans and commercial lending, which are focused on building scale, while the consumer durable loans, personal loans and the vehicle financing loans are focused on maximizing profits. The asset under management is roughly broken up into personal and consumer durable loans, which occupies around 35% or contributes around 35%. Mortgages, loan against properties and home loans, contribute around 12% to the AUM. SME and vendor financing is contributing around 12%. Vehicle financing is around 11%. Rural financing is 12% and loan against securities is 4%. Other loans contribute around 13%. At the consolidated level, which includes all the companies inside Bajaj Finance, the assets under management grew by 27% to 1,47,153 crores. This is the total assets it manages, with Bajaj Housing Finance Limited, which is a subsidiary of Bajaj Finance, contributing around 22% to the AUM. The housing finance is the vehicle for Bajaj Finance for growing the mortgage businesses, and it has attained significant size and scale in the last 2 years as a total share of the AUM for the Bajaj Group. If you look at the consolidated level, the asset under management is roughly broken up into personal and consumer durable loans, which accounts for around 27%. Mortgages, again loan against property and home loans, contributes around 29%. SME loan and vendor financing around 10%. Vehicle financing around 9%. Rural financing around 10%. Loan against security 3% and other loans contribute around 12%. While the company has been reporting strong growth in the AUM over the past 5 years at a CAGR of around 27%, the current economic environment along with the COVID-19 has impacted growth. Over the medium term, the company is expected to outpace the industry growth rate. Capitalization is strong with a sizable net worth of around 32,671 crores. Its Tier 1 capital adequacy ratio is also strong at around 26.4%. This is calculated to understand against the net worth what is the free or safe capital that the company has. Gearing, which is the debt to equity ratio, was comfortable at 3.3 times as of March 2020. Adjusted gearing has been below 6 times over the past 5 years, despite aggressive growth in the assets under management. The company has raised capitals at regular intervals to keep the gearing matrix under control to keep the debt to equity ratio under proper control. Over the past 5 fiscals, the group has raised around 14,900 crores of equity, which has increased the net worth of the company. With the recent capital raise being of around 8,500 crores in November 2019. Each time the gearing metric comes close to 7 times, the capital raising plans have been initiated and concluded. The company has a healthy capitalization levels, and that helps it to absorb potential losses on its portfolio. The adjusted net worth to net NPA was also healthy at 34 times as of March 2020. March 2019 it was around 27 times, which therefore means that the company's net non-performing assets are quite low when compared to the net worth it has. Company's capital profile is comfortable over the medium term, which means that the company is regularly infusing capital, and it has also demonstrated a good ability to raise capital. It has healthy internal cash accruals, thus providing cushion against the asset side risk. Return on managed assets, that is assets under management, annualized remained healthy at around 3.8% in 2020 against 3.9% in 2019. So it's almost as same as 2019, despite the additional provisioning of 1,420 crores, which includes 129 crores for ECL losses or expected credit loss recalibration, 900 crores for the COVID-19 contingency provision, that is based on moratorium granted by the government and RBI, and 390 crores for the other 2 stressed accounts that it expects would contribute to the non-performing assets. The company has made additional provisioning of 1,450 crores in the first quarter of 2021 for the COVID impact. Thus, the overall COVID related provisioning is around 2,350 crores. The return on managed assets was driven by higher fee income and a stable net interest margin. So here earlier, if we look at the overall return on managed assets, it means that the total AUM, which was around 1,46,000 on a consolidated level, on that it is earning around 3.8%. The return on managed assets was driven by higher fee income and stable net interest margin. Profitability should continue to be better than the industry average. The earnings are susceptible to high credit cost, especially during this macroeconomic stress of COVID, and despite the conservative provisioning policy, earnings has remained susceptible to high credit cost, especially during the continued macroeconomic stress, despite the conservative provisioning policy. The profitability may moderate as a proportion of mortgage loans increases under its housing finance subsidiary. It is expected to remain better than that of peers though, which means that the mortgage loans are basically secured loans, and on that the company generally earns less interest compared to unsecured loans, and therefore that can put more pressure on the margins if the overall proportion of the mortgage loans increases in the portfolio. As mentioned, this is a strategically important company for the Bajaj Group, and it receives significant financial, managerial and operational support from its parent, which is Bajaj Finserv. It also derives synergies from being a captive financer for Bajaj Auto. So most of the Bajaj Auto financing happens through Bajaj Finance. It is one of the crucial entities of the group's financial services business. It also plays a critical role in helping Bajaj Auto meet its sales target. If we look at the amount of vehicle financing it did for Bajaj Auto, it was around 53% in 2020 compared to 20% in 2010, which has increased increased quite substantially from where it was in 2010, from 20% to 53% in 2020. The financial flexibility has steadily improved over the years, supported by performance of its operating companies, that is companies within or its subsidiary companies, including the insurance ventures. The company has sufficient financial flexibility to support any requirement of Bajaj Finance if it wants to increase its stake in the insurance venture. On the asset quality front, the company has managed its asset side risk well so far, with the reported non-performing assets, gross non-performing assets at just 1.6% as of June 30th, 2020. Earlier also, it was 1.6% in March 31st, 2020. That is just 3 months back. Also, it was almost at the similar level. A significant portion of the company's portfolio, comprising mortgage loans, has witnessed strong growth over the past few years. The company has a high exposure to risky assets, such as segments which includes personal loans, consumer durable loans, 2 and 3 wheeler financing, unsecured business loans, and all of these total contribute around 58% to the total loan portfolio as of March 2020, and these are vulnerable to economic cycles. Also, the company's ability to manage collections and asset quality during this period of lockdown, with slow lifting of restrictions and weak macroeconomic environment, is a key monitorable. As of June 30th, 2020, 16% of the AUM was under moratorium, which was granted by the RBI to all the borrowers who had taken loan from NBFCs and banks. But this has come down quite drastically from where it was in April 2020 at 27%. So from 27% it has dropped to around 16%. So many of its customers are paying back to the company. But any delay in return to normalcy would put pressure on collections, and that could also deteriorate the asset quality metrics. The asset liability mismatches across 1 year is positive, which means that the company has enough assets to pay off all its liabilities which may arise in 1 year. As of June 2020, the total debt repayment up till September 2020 was around 12,154 crores. This is how much it has to pay till September 2020, and up till March 2021 it has to pay around 27,617 crores. Against that, it had a liquidity in the form of cash equivalents and unutilized cash credit lines of approximately 19,586 crores. So this money it already has with it. Other than that, whatever comes through the recovery from loans, that will, so it is basically, it has surplus cash to pay off all its liabilities. The negative factor would include any deterioration in the asset quality, which will directly put pressure on its earning profile, and therefore it would lead to a drop in return on assets or assets under management, maybe below 2% on a sustained basis. Also, any significant change, a major change in the AUM mix due to an increase in the secured portfolio, will inherently impact return on assets negatively. As I mentioned earlier, as we saw earlier also, the company's mortgage loan or mortgage portfolio has been increasing substantially, and this is a secured portfolio, and therefore the amount of interest it earns on that is significantly low compared to unsecured loans like 2 and 3 wheeler financing, etc. So basically that can negatively impact the amount of returns it generates on the total assets it has under its management. So this concludes my brief analysis of the company's working and what is happening in the company currently and what is the future prospect of that. Moving on, in part 2 we will look at the company's balance sheet, profit and loss account, the cash flow statement, and also the quarterly profit and loss account. But these, what we will be looking at, it will be not in any particular order, as in we won't be just looking at the balance sheet, but we'll look at the actual flow as to how the company is managing its assets how it's managing its debt, and so on. So that would be in part 2. Welcome to the part 2. Before we move on at analyzing the financial statements, let us quickly look at the summary of balance sheet and profit and loss account. This will help us to focus on which portion we should pay more attention to. On the left hand side, I have the balance sheet up till March 20. The total balance sheet size is around 1,64,391 crores. Of that, the debt is occupying, that is borrowings the company has done, is of around 1,29,806 crores, which is almost 79%. Equity is contributing around 20%, that is the net worth is approximately around 32,328 crores. And other liabilities are a very insignificant small portion of around 2,257 crores. Moving on to the distribution of capital or the asset side, we have total assets or fixed assets of the company of around 1,321 crores, a small portion, just 1%. Accounts receivables are also just 1%. So the main focus that we need to keep on is the investments and the other assets, which are a significant portion of the asset side. Investments are of 17,544 crores, of around 11% of the balance sheet size, and other assets are around 89%. This is the amount of loans that it has sanctioned of around 1,45,526 crores as of March 2020. On the right hand side, we'll quickly look at the profit and loss account summary. The total revenue side is around 27,227 crores as of March 2020, and the amount of expenses that it has incurred is 38% is going into operating expenses of around 10,273 crores. Interest cost is also quite substantial at around 36%, which is almost 9,857 crores. So out of the total revenue earned of 27,000 crores, the company's interest cost is almost 36%. Depreciation expenses is pretty small. Depreciation expense is just 316 crores, and taxes is just 6%. Net profit is 18% of the total revenue, which is a substantial, and net profit is 18% of the total revenue. This is a good value of around 5,030 crores earned up till the recent 12 months. Next, let us move on and look at the financial statements of the company. Today I am analyzing Bajaj Finance Limited's financial statements. We'll begin with, in no particular order, we'll look at the balance sheet, profit and loss account, the cash flow statement, and the quarterly P&L account, but again in no particular order. And through this analysis, we'll try to understand whether this company is worth investing in, and not only that, but if there are some potential red flags or problems that also if we can detect through this analysis. This is the main purpose of making this video, is not just to understand if this company is worthy of investment, but also if we can detect some potential problems and try to then not invest or avoid this company altogether. So this will serve both the purpose. Let us begin by looking at the equity percentage. This particular ratio makes us understand what is the equity contribution in the business, or the shareholders' contribution in the business, compared to the total source of funding the company has in the business, in its balance sheet, that is. So in March 20% of the total balance sheet size was occupied by the net worth or shareholders' contribution. This is the money which can be said to be contributed by the shareholders, of around 32,328 crores, and this has sharply gone up from where it was in March 17 of around 15%. Earlier also in March 15 it has become 15%. So company has raised capital and increased its net worth to around 32,000 crores compared to where it was in March 17 and 15. But if you also look at the amount of total sources of funding the company has received, that's around 1,64,000, and that has also sharply went up from where it was in March 17. So this 20% is quite acceptable for an NBFC, because most of this companies working is in terms of lending of money. The debt percentage, the debt is contributing or borrowings in the company is approximately around 79%. Almost 1,29,000 crores of borrowings are there in the company up till March 2020 out of the total balance sheet size of 1,64,000. So we can see the debt to equity ratio, the net worth or the shareholders contribution is 32,000 crores and the company has borrowed 1,29,000 crores. So in the later on we'll also look at the debt to equity. So we can see stability. What we have to look at here is how stable the debt is over the years compared to the total assets of the company or total balance sheet size of the company. So from 81%, 77 and 79, so it has remained around this value throughout the years of March 15, March 17 and March 20. The amount of borrowings have increased substantially. That shows that the company is lending out more and more throughout the years, and this shows that the company has business in its books, because if there is no incremental lending activity, then this is the main core business of the company, and if you cannot see that the company is lending more and more, then that's a potential problem in fact. So here it's good that the company is increasing its borrowings, but as a percentage of total assets this is quite high, but this is understandable because it's a finance company and therefore its debt would be high. Later on we'll also need to understand what is the debt to profit, so that we can understand if the company is borrowing, if the company's debt is very high compared to the profit it is earning. That we'll look at separately when we look at the ratios or individual ratios or in the peer group comparison. We'll look at it at that time. We'll look at how much profits it is making on the net worth of the company. The company's net worth as of March 20 was 5,264 crores. On that, rather the profit was 5,264 crores, and on net worth of 32,328 crores it has earned this much profit, which is almost 16%. So the ROE is good in terms of it being above 15%, but it has slightly dropped. There's some pressure from 15, 17 and to March 20. We can see from earlier in March 15 it was 18.7%, then it increased to 19.1%, and finally in March 20 it has seen some pressure and gone even below where it was earning in March 15. So 16.3%, but yet it is good compared to the, in terms of my benchmark of 15% ROE for companies. Let us look at the long-term trend of last 7 years, 5 years and 3 years and see how the company has performed over the average periods. So last 5 years if you look, the average ROE was around 17.8. So if we have to look in terms of long-term trend, because when we are investing for at least 3 to 5 years, so we have to look at both these figures and see what is the average. 1 year can fluctuate a lot year on year. ROE values or ROCE values can fluctuate, but over average periods how is it performing? So last 3 years, that is March 20, 19 and 18, last 3 years the average is working out to around 17.4%. So this is good. Even last 5 years also 17.8%. So in terms of profitability on the net worth, this is good. The ROCE value will be of course low because the amount of capital employed or the debt, this capital employed includes your net worth as well as your borrowing. So this is the total source or total capital employed into the business, excluding the current liabilities or long-term liabilities or other liabilities for that matter. So on total 1,62,000 crores, the company has earned 16,930 crores of EBIT, not net profit but EBIT, EBIT, earnings before interest and tax. So that works out to around 10.4%. And here also we have to look at the stability of how it has performed over the years. So 15 it was 11.5, in 17 it was 11.3, and in March 20 of course there's some pressure of around 10.4%. That pressure was also seen in the ROE values. So overall from 17 to 20, in 3 years the profits have increased from 6,600 crores to 16,930 crores. This is the top line profit, EBIT, EBIT. So on total source of funding that the company has received through net worth or through equity shareholders as well as through borrowings is 1,62,000 crores. On that it has earned a profit of 16,930 crores. That's a 10.4% of net profit on the total capital employed. This is the top line profit that has to be kept in mind. Let us look at the long term averages of 5 and 3 years. Here too it has shown a slight decline over the average periods of 7, 5 and 3 years. In the last 3 years the average return on capital employed is 10.5%. It is understandable that in most of the financial companies will not get more than 10% or not more than 15% of ROCE values, because the amount of capital employed is basically leveraged. The company has received more source of borrowings or has done a very high borrowings compared to its net worth, and therefore ROCE value will understandably be low. Return on total assets. This is the total assets of the company or total balance sheet size of the company. This includes all the assets of the company or whatever sources of funds the company has received, everything, including everything. On that, how much was the net profit? Here too we can see that in fact here it has been improving over the years from 2.7% to now 3.2% in March 20. Net profit in March 20 was 5,264 crores on a total assets of 1,64,000 crores. Now again, as I mentioned earlier also, the company is on leverage, so their debt is quite high. So comparatively we'll see a low ROA, but we can look at the trend that it's in an uptrend, where it was in March 17 a profit of 1,836 crores. On that, in the next 3 years it has increased to 5,264 crores. So the profits have been gradually increasing as the amount of total assets have been increasing. So this is a good trend. We need to look at the trends also, not just the individual values. Let's look at the debt to equity ratio. The debt to equity ratio in March 20 has stood at, in fact it has come down to 4 times. Earlier in March 17 it was 5.1 times. On a total debt in March 17 of 49,000 crores, the total equity contribution was just 9,600, 5.1 times. Even this is reasonable for financial companies. Generally it goes above 7 times, 8 times or maybe even 10 times for many of these companies which work on leverage, or they borrow more than their net worth or their equity. But here the company has maintained below 6 times throughout these years from March 15 till March 20, the data that we have. So the total debt as of March 20 was 1,29,000 crores and the equity contribution was around 32,000 crores. Earlier when we were doing the analysis or when we were looking at the company profile, we saw that the company has been raising capital constantly over the years, and this is being reflected here in March 20. So the overall debt to equity has come down now to 4 times. So this is a good value. Net block percentage basically measures the amount of net block or net assets, fixed assets of the company. What is the contribution of that to the total assets? Generally it will be very low for financial companies, as we see that their total assets are very high, but it doesn't need physical assets as such, because most of it is financing and it's a service based industry. So here this is not very important, and also it's reflecting in the amount of values. Debtors are, again, since the company would not have any debtors, this value is also not that significant, so we can skip this also. Investments, generally in financial companies, whatever it lends, whatever remains after that lending goes into investing activity. So we can see that over the years the amount of investments it is doing has increased quite substantially to around 10.7% from where it was in March 17 at 6.4%. So the total investments, this investments could be long term as well as short term investments, and whatever it cannot lend, it would put it into investing activity, therefore to earn interest out of that. These investments could be with the RBI or interbank lending or anything it could be, or even in mutual funds or whatever, any type of investing activity. So around 17,544 crores of investments in March 20, which is almost 10.7%. This value too is not high, but it has been increasing substantially. Generally we don't want to see too much of investments. If the company can lend, then that's good, but if it cannot lend, it will transfer it into investing activity till it can start that lending process again. One more thing that it could have substantially increased this investments is because to pay for any upcoming interest or principal amount that it needs to pay of whatever it has borrowed. So that could be again a reason that the company may have transferred or kept a substantial amount of investments as liquid so that it can sell it off and pay off that whatever principal amount is coming up, or the amount of loans that it has to service back again or pay off again. Cash holding is quite reasonable at 1%, 1,383 crores. So it has investments of around 17,544 crores and a cash holding of around 1,383 crores. So this is quite reasonable as of now. There wouldn't be any, neither would be there will be any capital work in progress or inventory as well. This is a service based company and into lending of money or financial activity. Let's look at how the sales have been growing over the years. In the last 5 years, the sales or the amount of revenue it is generating through lending activity has been increasing at a CAGR growth rate of 37.3%. In the recent 3 years at 38% from 17 to March 20, which is a very high growth in terms of generating revenues or top line revenue. Even in the recent 12 months, that is from March 20 to the recent 12 months, it has gone up reasonably at around 3.19%. So the company has been growing its sales or generating its revenue at a very good healthy CAGR growth rate of around above 35% through these last 5 and 3 years. This is very important to look at because everything starts at the top line, how the company's demand is there. In either in terms of product or in terms of finance like lending activity. So in both that, whether we are looking at a trading company or a finance company, we should be able to see a high growth in terms of sales over the last 5 and 3 years. I have modified in the way I am analyzing from my previous videos. This is I have arranged these values or these line items of the profit and loss account balance sheet in a particular order, although there is no order in terms of balance sheet or P&L account, but there's a gradual flow of how we can understand. What I've done is when we started, we looked at how much was the source of fund, how much the company was receiving from the equity shareholders, or what was the source of funding basically from debt and equity. Then we looked at what is the debt to equity, how much profit it is making on the net worth or shareholders money, and how much profit it is making on the debt, and so on. So we kept on moving from ROCE, ROA. Now we look at sales growth, how the company is generating its revenue, and is it managing to be in positive, is there demand in its lending activities. That is what we are trying to look here. How is it growing its net profit over the last 5 years? the profits are growing at a CAGR growth rate of more than 40%. In March 15, it had a profit of 898 crores, which has increased to 5,264 crores in March 20. That's a multiplication of almost 42% every year, compounding of almost 42%. In 3 years also, it has managed the same speed of around 42.1%. Although in the recent 12 months, the profit has slightly dipped due to economic downturn and the COVID problems. So from 5,264 crores in March 20 to the recent 12 months, it has dipped slightly at around 5,031 crores, a negative 4.4%. But over a long term period, since we are going to invest for a long term of 5 and 3 years, we have to look at the long term story. Although this is also important to see what is happening currently in the company, and if there is a substantial change in the current scenario, then we can take a decision either to exit or reduce our exposure, or whatever we think is fit at that particular point of time. But over a long term trend, it is very good, and it's showing a very high strength in terms of growing not only its revenues but its profits as well. Debtors turnover is not important, as well as debtor days, because the debtors are not that substantial. This is the lending activity, so there are no trading going on in the business. Debtors come when there is a lot of trading happening in the business. The company has no raw material cost, but the employee cost would be substantial as it is into service industry, and the employee cost have been growing gradually to around 9.69%. Although this is still reasonable and below 10% of the total revenue it is generated at the top line. Interest expense for a financial company is very important to look at. In the recent 12 months as well as over the years, the trend has been above 35% of its revenues go into servicing its interest cost, because the company has a huge borrowing, therefore it has to pay a high interest cost. But as we saw, even this is very good for a financial company at around 36%. Generally the interest cost goes above 50%, 60% for financial companies. It's like a business, like a trading for them. Money is a commodity for financial companies. Just like for a trading company, the raw material cost would be around 60%, 70% of their expenses. Similarly, for financial companies, interest expenses would be a substantial portion, and therefore needs to be monitored carefully at all stages. We can see here quite a stable trend of around less than 40% over the years. On the total sales of 27,216 crores in the recent 12 months, this recent 12 months includes the latest quarterly data up to March June quarter of 2020. So the total interest it paid in these 12 months or the recent 12 months is 9,857 crores, which is around 36%. In March 17 also, on a total sales of 9,970 crores, it paid 3,853 crores. So the percentage wise, it's quite stable. Depreciation, as we earlier saw, the amount of fixed assets it has is very less for a financial company. Therefore, the depreciation percentage also wouldn't be that substantial. So we can skip this as well. The company's tax rate has come down to around 25.8% in the recent 12 months. So this also needs to be carefully monitored as to whether the company is manipulating its amount of taxes it is paying. Is it deferring or is it postponing the taxes it has to pay to future quarters or future years? And therefore it needs to be monitored carefully that it should not drop substantially to increase profits. Many companies manipulate the amount of taxes it pays to the government and therefore either increase or decrease their profits. In March 17 it paid around 981 crores. In March 20 around 2058 crores, which is around 28.1%. In the recent 12 months it has paid around 25% of its profit before tax of 6,780 crores. So this also, there doesn't seem to be any manipulation here. Other income as a contributor to the total revenue of the companies should not be that substantial that it contributes a major portion to the net profits, and therefore is again a monitorable that we need to keep looking at, because many times companies have other sources of income and that can manipulate the net profit. So here the company doesn't have that much sources from other income, and therefore less chances of manipulation. The average OPM margin generally for financial companies would be above high. It would be very high, in fact. Last 3 years it's around 67%, and in last 5 years also at around 67.5%. So because the operating expenses are not that much, the major cost is the interest cost and the tax for the financial companies. So the operating profit margin would generally be very high over the years. The average net profit margin over the last 3 years stood at around 20%. So since last 3 years on an average, its profit margins on the revenue is quite high at around 20%. This shows a very good sign, because for financial companies to earn high net profit margin is substantially low, and this therefore shows a good strength. For last 5 years also it was earning around 19.4%, and the average values therefore gives us confidence that over the long term the company has been doing well. In the recent 12 months the NPM margin has fallen to around 18.5%, of course due to a lot of economic problems and the moratorium that the government has declared on the banks and NBFCs, and therefore there would be some kind of net profit margin pressure. Let us look at how much was the net profit and what was the amount of cash that was flowing in or out of the operating activity. Generally for financial companies, the operating activity would generally show our cash outflows, and that is understandable because the company is in the business of financing or giving or lending out money, and therefore money is a commodity for them. So on a total net profit of 5,264 crores, the company had an outflow from operating activity of around 24,426 crores. This is the net of all the activity. In March 17 it was 10,000. So this needs to be going more and more negative. This shows that the company is doing more and more lending, or there is more cash outflows from the operating activity of the business. Over the average periods of the last 5 and 3 years, if we see, in the last 3 years on an average 74,000 crores has gone out of the operating activity, and in the last 5 years 94,000 crores. In the last 7 years the company has given out 1,01,000 crores from its operating activity. The profits on an average basis of 7, 5 and 3 years is in a declining trend. So in the last 3 years the total amount of net profit earned on an average was around 11,755 crores. Although this is also quite stable if you look at the trend. In terms of the amount of cash earned from operating or cash spent in operating activity and cash spent or received from investing activity, in March 20 the company had lent out of its operating activity around 24,000 crores and also had invested around 8,757 crores in its investing activity. So generally this will keep happening in a business where especially in a financial company, to understand cash flow statement is a little difficult because money is a commodity for them, and therefore it goes into negative. The company's investments in March 20 was around 8,757 crores. This is the investing activity, which includes investments in shares, mutual funds, or also investments in fixed assets of the company, or in increasing its fixed assets. Over the long-term trend, around 13,000 crores were invested in the last 3 years in the investing activity. This could also include investments in mutual funds and shares. And the total cash outflows from the operating activity was around 74,000 crores. So this is just to understand basically how much cash has been flowing out of the business from operations and how much the company has been investing or receiving money from the investing activity. So this shows basically a kind of a trend for us to understand how the company is doing in terms of operating cash flows and investing activity. The net profit margin in the recent 12 months, as we saw earlier also, is slightly dipped below 20% to 18.5. In March 20, on a total revenue of around 26,375 crores, it earned a net profit of 5,264, which is 20%, which is a very good value. March 17 also it was around 18.4%. The company has maintained quite a stable net profit margin throughout the years. If you look at the cash profit margin, again because the operating cash flow would be negative, this is difficult to analyze, but just to understand, on a total sales of around 5,392 crores in March 15, the company's outflows from the operating cash, that is how much cash went out of the operating in terms of operations of the company, it was around 7,000 crores. So we see that the company received 5,392 crores and lent out around 7,000 crores in March 15. In March 20, on a total revenue inflows of around 26,375 crores, company lent out around 24,426 crores through its operating activity. We can also analyze the operating cash flow separately to understand the components of the cash flow statement, and that will give us a very good idea as to what is happening in the company. So this is quite stable here too, and we should see higher outflows from the operating activity of the business in terms of financing. The amount of depreciation it is charging on the assets it holds, or gross block it has, the total assets, is around 18.2%, and this is quite stable. It's not very high considering that its asset base has increased from 437 to 1616 crores in March 20. The amount of depreciation would also go up, but as a percentage it should be quite stable, which we don't see quite here. But the company is depreciating its assets quite fast at 18.2%, but that's okay because it doesn't have that much assets, therefore we can ignore this particular problem here. This is not a very substantial problem. Dividend payout is around 11.4% on the total net profit earned of around 5,264 crores in March 20. The company has declared 600 crores as dividend, which works out to around 11.4% on the total net profit. And the dividend payout policy has been quite stable at around 10% and above throughout the years. The amount of current assets and current liabilities comparison if we have to do, which is the current ratio, in March 20 the company's current liabilities stood at 2,257 crores against the current assets of 1,45,526 crores. Again, this would be little manipulative because here the current liabilities as such, in the current assets, basically this data has been sourced from Screener, and therefore their current assets basically includes all the loans that it has given out, and current liabilities does not include the borrowings, and therefore this mismatch. So we can basically ignore this. This is not that important for a financial company. Inventory turnover. Again, the company, since it's in a financing business, wouldn't have any inventory, so we can ignore this also. Interest coverage is very important to look at. On the total EBIT it is earning, how much of that EBIT it is paying off as interest expenses, or in other terms, how much times more is the EBIT compared to the interest it is paying. So in March 20, the amount of profits or top line profit it was earning was around 16,930 crores. Out of that 16,930 crores, it had to pay off 9,600 crores as interest, which means that the EBIT is around 1.8 times higher than the interest it is earning. Generally, for financial companies, the interest coverage ratio should be above 1.3, 1.4 times even if it's above 1.5 times, then it's very good in fact for a financial company. But for a trading company, it should be above 4 times. So this is quite a stable. Also, we can look at the trend, how the trend is over the years of above 1.5 times throughout the years of March 17, 20, and even in the recent 12 months. In the recent 12 months, it has paid slightly higher interest cost on, although the EBIT has slightly decreased to around 16,638 crores, and therefore the coverage has dropped to 1.7 times. The market cap to sales ratio would help us understand the valuation of the company or valuation of one share. What is the price of one share compared to the amount of revenue it is generating. So this is the valuation ratio. So per share, how much sales was being done, and on that what was the price of each share. So basically we are trying to understand if we are paying very high against the sales per share, and this is again a very important issue. When we are going to buy a share, we have to look at all these valuations. First we have to look at the metrics, different metrics like cash flow statement, the profitability metrics, the valuation metric comes at the last. Once we've decided that the company is good enough for investments, then we have to look at what its value is. Are we buying at a reasonable valuation so that we can earn a good profit on our investments? And therefore all these valuation ratios help, like price earning, price cash, price book, and so on, and price sales. So this is basically price to sales ratio. What is the price of one share and what is the sales the company is doing on one share. So here we can see the price of one share in the, at least at the recent 12 months, the price of one share is 8.1 times higher than the sale it is doing per share. So on the total sales it has done in the recent 12 months of 27,216 crores, its market cap or the entire value of the company in the market was around 2,19,000 crores, which is like 8.1 times higher than its sales of the recent 12 months. In March 20 it was 5.1 times. This was quite reasonable. So the lower it goes, the better it is. This is the right time to buy when the market cap to sales ratio falls. And right now it has increased up quite substantially within this, from March 20 to the recent 12 trailing months. It has, the overall market cap has gone shot up quite substantially from 1,33,000 crores to 2,19,000 crores. And we have seen this increment in price from March 20 to the recent 12 months in most of the companies, where these companies have seen increment in their share price by almost 50, 60 or maybe even 100% in many of these companies, sometimes 2x, 3x also in many of these companies. So this has become slightly expensive compared to its past, where in March 17 and March 20 it was slightly below 7 times. Here current valuation is quite expensive at 8.1 times. So either wait for the average of these two. So say around 6.2 times if it comes, then we can think about buying into this company, or something sort of that we can club together and make a matrix of our own, and then take a decision where we want to invest, at what price points we want to invest. So even if we take the averages of the last 5 years or 3 years in terms of market cap to sales, look at where this multiple was, and then take a decision whenever the market cap or the price of each share comes down. At that time we can buy into this company. Right now it seems quite expensive. The price to earnings again would compare what was the profit on one share and what is the price of each share. So in March 20 the company's earnings, that is profit per share, how much profit it earned on every share, was 87 rupees, but the price of that one share was 2,216 rupees, which is almost 25.3 times. Earlier in March 17 the price to earnings was around 35.1 times, and now it has gone up quite substantially at 43.7 times. So this is very expensive as of now. So there's no way that I would buy at this valuation, where the price has shot up to 3,646 rupees per share and the earnings has slightly dipped to around 83.5 rupees. Generally, if the earnings or profits per share is dipping, why should the price be going up? That's a question that we need to ask. and if it is going up, then we don't need to buy into it. We can wait patiently for it to fall down and then go into buying that share. Let's look at where the averages of the last 5 and 3 years stands. So in last 3 years, the average price earning of this company had been around 36 times. So even if we look at the recent 12 months, which is 43.7 times, that too is very expensive. So we can wait for, generally my benchmark is around 25 times, but many of these companies don't come to 25 times. So then we have to take the averages of 5 and 3 years and see where we can buy. So what we can do is, if the recent 12 months price earning or the latest price earning comes to around 36 or 34 times, then that is a good time to start buying or accumulating the shares of the company. So it is very expensive right now. So what this 43 times means is that the price has gone up 43 times, or it's at 3,646 rupees, but we cannot buy at this valuation. So it needs to fall, the price needs to fall to around 25 times of 83 rupees. So that works out to, or maybe we can even go for 36 times. So what we can do is, we can multiply 83.5 with 36 times. So that would be a price of around 3,000 rupees. So 3,000 rupees would be a reasonable value. Below that we can buy, going down till 25 times. That is at the current profit of around 83 rupees, 83.5 rupees into 25 times. So till 2,000. So from 3,000 to 2,000 rupees we can accumulate, because this is the average of its price to earnings. Similarly, we can do the same calculation for the price to sales or market cap to sales ratio that we saw earlier, and the same way we can calculate what price range can we take to accumulate this stock. So but as of now, the recent price earning has gone up too much high, and therefore it needs to come down substantially for us to accumulate. The March, April, May, June values, or the market was very good for accumulation. Whoever accumulated in this time, people who had cash holding, they benefited out of it. Let's move on and look at the price to book. Again, a valuation ratio against the net worth of the company, the equity shareholders contribution, what is the market cap or what is the price of each share. So the total net worth as of March 20 was around 32,000 crores, and the market cap was around 1,33,000 crores. So which is like a 4.1 times multiple. Here I wouldn't buy. My benchmark as such is 2.5 times. Price to book should not be more than 2.5 times. But that is, the company's market value or value in the market should not be more than 2.5 times its equity shareholders contribution. That works out very expensive. But as we can see, March 17, March 20, it had dropped quite substantially to 4.1 times, although not that much to my benchmark, quite high and above my benchmark, yet it had fallen quite substantially. But in the recent 12 months it has gone back at the March 17 values of around 6.8 times. I have taken the net worth of as of the March 20 values, as we don't have, generally screener wouldn't provide the recent 12 months net worth. So I've taken the March 20 values. Even considering that, the market cap or overall share price of the company has gone up quite substantially from where it was in March 20 at 1,33,000 crores for the entire company to 2,19,000 crores. So the company's overall market value has increased quite substantially, and therefore its multiple has gone up. So now if we want to buy based on price to book, then we can wait for, say, an average of 6.7 and 4.1. So say somewhere around 5x or something like that. So in that case, a 5x works out to, on 32,000 crores, 32,328 into, say, 5 times, which works out to a total market value of around 1,61,000 crores. So from there we can keep on buying till the March 20 value of 1,33,000 crores. So this we'll need to keep monitoring as to what is the value of the company in the market on either on a weekly basis or on a monthly basis or on a daily basis, and thus take our decision. Debt to net profit ratio. Earlier I spoke what was the ROE. ROE was the profits earned, net profit earned on the shareholders' contribution. We also want to see on the borrowings how much the company is earning as net profit. So in March 20, on a total borrowings or total debt of 1,29,000 crores, the company has earned a profit of 5,264 crores. In other words, either we can take that as a multiple, or we can look at how many times more in terms of percentage is the debt. So debt is almost 200 and, or rather, let me just calculate this. $126, or rather 129,806 divided by 5264, which works out to around 24 times. So the debt is around 24 times higher than the profit it is earning. So if the company has to pay off this debt, it will require 24 years of net profits of March 20 what it earned, and for 24 after 24 years it can clear off this debt. So the debt is quite high. We also will have to check with the peer groups where other NBFCs debt to net profit ratio is. This basically is a very important ratio to understand, to see how much debt is there and how much profit it is earning on that debt. Is it reasonable? Is it very low? If it is low, then why so much debt the company has taken up if it cannot earn substantial net profit on that debt? So then that's a burden, that's a problem. Then it becomes a problem for the company if the company is increasing its lending but not receiving profits on its book. Earlier in March 17 and March 15, if we see, it was, in fact March 15 it was 29 times, that is the total amount of debt was 29 times higher than the profit it earned. That reduced substantially to 26 and now to 24. So the company is gradually, although its overall debt is increasing, but its profits are also increasing. In fact, its profits are increasing at a faster rate than the amount of debt it is increasing on its book, and therefore the multiple 24x, it's coming down to around lower and lower from 29 to 24. So this is a good understanding. This particular ratio gives us a good understanding as to how the company is doing in terms of managing its debt and also how much profit it is earning over the years on the total debt it has borrowed or the total debt it has on its book. Let us recap the valuation ratios, see how high the valuations are currently. These are all the latest values. Price to earnings is very high at 43.7. It has to come down quite substantially for us to buy into it. Price to cash is negative and therefore can be ignored, because financial companies we cannot make out what this means. Price to book again very expensive at 6.8, needs to come down to around March 20 values, although I'm not sure if this again that opportunity will come, but if it does, then it becomes a very good opportunity to buy into the shares of the company. Market cap to sales ratio is also very high at around 8.3 times. Again, this also needs to fall. So basically the price has shot up quite substantially and needs to come down for us to buy, at least for me to buy. Let us look at the price variation, how the price has moved from March 15 to the current market price and from March 17 to the current market price. We'll ignore the March 12. March 15 the price per share was 410 and currently it stands at 3,645. So that's a 54.7% of CAGR growth rate in price. So anyone who has invested in March 15 has seen its profits increasing at around 54% every year on a compounded basis. That is, the price has gone up by 787% or 7.8 times in the last 5 years. In the last 3 years or the recent 3 years, the prices have increased or compounded at 46% from 1,171 crores to 3,645 crores, and that's a multiple of around 2.1 times from in last 3 years. So this is a very good compounding rate for the profits of the shareholders. So even if you had bought 5 years back or even if you had bought 3 years back, you would have still doubled your money in the recent 3 years, which is a very good value. So we can take this trend and look at how, if we invest today, what kind of growth can we see. So maybe another 2x, maybe 1x in the next 3 years. So even in that case also, this is a good ratio or the good price variation layout that we can look at and make our decision as to how the company has been compounding its share price over the years and how it is growing its share price. So this gives us a good confidence that we can buy even now and expect that it will keep growing its value over the years, assuming that the company is growing. Of course, we saw that the sales and the profits were growing quite substantially over the years. Let's finally analyze the quarterly data. Sales over March 20 to June 20, quarter on quarter, has dropped by 8% due to a lot of economic downturns, COVID, moratorium and all those stuff. So basically the sales has seen a drop of around 8%, and YOY from June 19 to June 20 it has seen a growth. So this at least shows quite some strength, although it has fallen below the March 20 revenue that it generated. NPM is at 14%, fallen quite substantially from where it was in June 19 at around 20%. The profits has fallen down to 962 crores in June 20 on a total revenue of 6,648 crores. So not only has the revenue fallen from March 20, but the profits has also fallen from 948 to 962, although that not that substantial. Profits have grown at 1.5%, although the sales had dropped by around 8%, but the profits have grown by quarter on quarter at 1.5. But the overall YOY, if you look, it has fallen at around 20% in terms of profit, again due to these short-term economic problems that is going on. And this completes my detailed analysis of the financial statements of the company. Next, let us move on and look at the peer group analysis.